Good afternoon, ladies and gentlemen, and welcome to the Belvoir Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'll now like to hand you over to CEO Dorian Gonzalez. Good afternoon, sir.
That was great. Thank you very much for your very kind and informative introduction. My name is Dorian. I'm CEO of BELVOIR Group PLC. I'm here this afternoon with Louise, CFO of the BELVOIR Group. So first of all, very brief introduction to us. As I say, my name is Dorian. I've got 25 years, or I had 25 years experience in the property sector. I've been with BELVOIR for 18 years, I do have shares in the business, plus Louise and I both have LTIPs, i.e. share options and LTIPs going forward, but we both do have a stake in the business. Louise has got 21 years experience on AIM boards, 9 years experience with BELVOIR. And it's incredible when I think back to what the business looked like sort of 8 or 9 years ago. Then we had just one brand when we first listed on AIM back in 2012. Now we've got 7 brands, which I'll talk you through as we go through the presentation. Our current market cap is 62 million, and dividend yield as of the 24th is or was 5.4%. FinCap's research, their research note is available, and there is a link in the presentation. They've set a target price of 375. As was said at the very beginning, we have had a small number of pre-submitted questions, and I haven't yet decided whether I'll keep them until the end or whether I'll tackle them as we go through, but I'll decide shortly. But if you do have any questions, please submit them in the chat box, and we will do our very best to answer all of them. Okay, so just a brief introduction to the business itself. So at the heart of our business, we are a franchise business. And if you've ever heard me speak in the past, you'll know that I'm hugely passionate about franchising as a business model. It's robust, it's rewarding, and if a franchise model works well, it works extremely well for both the franchisee and the franchisor. So if it's done properly, it works for both parties really well, and ours does work for both parties, as I'll demonstrate through the presentation. So on this slide, in the first, the block of 6 boxes, these are our property brands. So Belvoir, Newton Fallowell, Northwood, Lavelle, Humphreys, and Mr. and Mrs. Clark. The most recent addition being Mr. and Mrs. Clark. Belvoir being the first brand, and as I say, when we listed on AIM back in 2012, we listed as a residential letting specialist. We didn't have any involvement in estate agency or mortgages or anything else. It was just simply a letting specialist. In fact, we were one of the only letting specialists operating when we listed on AIM. Since listing, we've branched off into estate agency and financial services, and I'll explain those journeys as we go through the slide deck. On the right-hand side of this slide, the second part of our business is financial services. So we now have 284 mortgage advisors. The vast majority of those advisors are self-employed, but some of them are employed. But it's very much weighted towards a self-employed model, similar to the franchise model. One question that we tend to be asked quite regularly is do we run any of these franchised offices ourselves? The answer is yes. I'm sitting in Grantham in our main office, and along the high street we've got a Belvoir lettings office that manages maybe 450 properties, and then further down the high street we've got a Newton Fallowell estate agency office that also does lettings that we own directly. So within this town we have 2 branches that we own, and then aside from that we've got a part of the Humphreys business we acquired, and we are looking to franchise out. So we've normally got a couple of offices that we own and operate. That also is really helpful in franchising. If the franchisor actually does it, and they can put a flag outside and say, look, this is what we do. It generally means the franchisor has got a much deeper understanding of the business model, because we're practitioners as well as franchisors. So some of the strategies that we've been working on over the last 12 months. So I mentioned Mr. and Mrs. Clark earlier. I won't dwell too much on it. It's a relatively new business that we acquired along with Mr. and Mrs. Clark, i.e. the founders of the business. They now work full-time within Mr. and Mrs. Clark. It's a business we acquired last year. We've spent a few months sort of working on the structure of the business. We do intend to introduce a lettings part of that business too, but at the moment, just a estate agency. We've had some growth in that business, but it's yet to sort of gain any traction. Very early days, but it's a model that we believe in, and it's a model that we are looking to develop in the future. The second acquisition that we made last year, it was the Time Group, which is a financial services business. It was a network of 63 advisors located mainly in the Northwest and the Midlands. It operates under Mortgage Advice Bureau. Revenue of 4.2 million, profit before tax of 0.7 million in the year to July 2021. It added in the relatively short period of ownership last year, it added 2.7 of revenue and 0.4 to profit. So good acquisition for us. Anybody who's been following our story may remember that we have made 4 financial services acquisitions since 2017, so relatively short period, over 5 years. We've paid around 10 million for those 4 acquisitions. They've added about 15 million of gross profit since we bought them, and in EBITDA terms, they've added around 9.5 million of EBITDA over that 5-year period. So it's fair to say that we're very pleased with the acquisitions. They add value to the business, and we are going to continue on the financial services journey that we're on. The third part of this slide is our assisted acquisitions program. So there are 2 different types of acquisition that we focus on. One is corporate, such as Mr. and Mrs. Clark, Time Group, Newton Fallowell, Lavelle, sort of larger businesses that we've acquired over the last few years. The second type of acquisition that we do, we work very hard to help our franchisees to also acquire businesses, and we've helped our franchisees to acquire 126 businesses over the last seven or 8 years. Last year, we helped franchisees to acquire 3.9 million of extra revenue. And as a franchise business, we then get a percentage of that revenue for the lifetime of the clients. So at the top of the slide, you can see that the MSF, as we call it, or management service fee, is really the royalty that is paid to a franchisor for belonging to the business model. We generated 300,000 of extra MSF last year from what we call assisted acquisitions. And why we call them assisted acquisitions is that we help a franchisee to identify targets. We actively canvass these targets. I've got 5 full-time people in this office here actively working within assisted acquisitions. We help put the deal together. We help with funding if a franchisee needs it. We'll also give small loans, and the group advanced 600,000 last year in small loans towards these acquisitions. But it's very profitable for us. It's very profitable for the franchisee. So the franchisee normally buys a lettings business, ports it across into their own business. They don't need to bring across all of the costs, and it's very profitable for the franchisee to do. We can see that because so many are happening. As I say, we've done 126 of these franchisee deals, sort of franchisee acquisitions over the last few years. The good news is that so far this year, we've completed on 1.2 million of franchisee acquired turnover. So it was 3.9 million in the whole of last year. So far this year, it's 1.2 million. We've got a further 1.6 million with lawyers, so they're deals that have gone beyond heads of terms, and then we've got a pipeline of other deals with around 2 million of potential deals in there that may or may not convert. Point being, at this point in the year, to have already completed on the deals that we have, and to have such a good pipeline with solicitors suggests that we're going to have a better year than last year again in terms of acquisition. So that's kind of where we are. I'll talk a little bit more about our appetite for corporate acquisitions later on. So before I pass across to Louise, the key highlights, really the full year. So revenue, again, it's a high point for us. It's a record for us at 33.7 million. That's up 14%. Profit before tax was slightly down by 2%, and profit after tax was slightly ahead of last year. Cash flow from operations, we've always said that we're cash generative, very cash generative. So 10.8 million of cash was generated from our operations last year, which was up 5%. And we finished the year net cash for the first time since 2015. So at the end of 2021, we ended the year net debt to the tune of 1.3 million. And then in 2022, even after paying for time and Mr. and Mrs. Clark using cash, which was around 4 million, we still finished the year which was a great outcome. Because we are so cash generative, it means that we are actively seeking acquisitions that we would like to complete on this year. We do have some deals that we're looking at, but that's probably the best I can say at this point in time. If you look back at our fairly recent history, we typically complete on 1 to 2 corporate deals each year, and in addition to that, we complete on a number of franchisee acquisitions. So there's the 2 different types of deals that we're involved in. Operational highlights: we're now in 487 locations, which is up 14%. A chunk of those are mortgage businesses, and the vast majority are property businesses. Financial advisors, we're up to 284. So that's an increase of 17%. House sales across the business, 10,970, which is an 11% decrease as the market starts to return back to sort of normal levels. If you've been following the house sales market, you'll know that 2021 and 2022 were a very busy year with more transactions than normal, and we're seeing a sort of normalisation. We saw a normalisation as 2022 played out, which is exactly what we forecast would happen. I'm very pleased to say that the number of managed properties that we're looking after is now up to 75,500. That's a 4% increase. If you move financial services to one side and just look at our property revenue, which is about half of our turnover and the majority of our profit, if you look at the property revenue, almost 80% of our property revenue comes from the management of these residential properties. So it's recurring, it underpins our business, and it always has. And it's great to see that number has increased in 2022. So before I pass to Louise, when I come back after Louise has covered the financials, I'll talk briefly about the market, our operation in slightly more detail, and then we'll do a wrap up and then start to tackle a few of the questions. But over to Louise.
Okay, so if we'd start off by looking at our income statement, the revenue from property was up 2% to 15.6 million. What we saw within this was 4% like-for-like growth in the letting side of the business, and 17% growth from franchise fees. Franchise fees are what our franchisees pay when they join the network. It's not their ongoing management service fees. It's effectively a joining fee. And these offset the reduction of 15% in the value of our property income. So broadly, on a like-for-like basis, we were on par with 2021. And the growth of 2% actually came from the net effect of our acquisitions and disposals, and I'll cover what they were in a little bit more detail shortly. On the financial services side, revenue was up 26% to 18.1 million, and within that we saw like-for-like growth of 4%, and the acquisition of Time added a further 22%. The gross profit, we were up 6% to 20.3 million. The property division had added 400,000, and the financial services had added 900,000. Gross profit margin overall, that came out at 60%, and that compared to 64% last year. And this move reflects the increasing proportion of revenue that is derived from financial services. So when you look at the two income streams, property and financial services, they're very different. So with the property division, all of the revenue drops through to gross profit. There's no direct cost associated with it. Whereas on the financial services side, there's quite a high pay away to the advisors, and also an amount that's paid away to the lead sources, the agents who provide the leads for the mortgages. So that as we get a higher mix of financial services within our revenue, we will see that profit margin, gross profit margin, go down. Within the financial services side, there was a little shift in the gross profit margin on that from 27 to 26%. And this reflects an increasing proportion of self-employed advisors following the acquisition of Time. So within our network of advisors, we probably have about 30 odd who are employed, but the vast majority are self-employed, or they operate under what we call a business partner model. So they're much more self-sufficient. They manage their own administration and chasing up their own mortgage applications, and so they're not as they don't require from us as much overhead and management. But they do earn a higher rate accordingly. And because we had that bigger mix of self-employed advisors, that slightly shifted the margin. Overall, we saw net profit down before tax down by just 2%, but our profit after tax is just marginally ahead. So group revenue was up 4.1 million to 33.7. The corporate acquisitions and disposals added a net 3.6 million. So if I talk you through what was happening on that side, because there's, as always is the case, there's a lot of moving parts. So on the corporate acquisition side, in March 2021, we acquired the Nicholas Humphreys network. So in 2022, we had a full year ownership of that network compared to 9 months in the previous year. But also within the Nicholas Humphreys network, when we acquired it, it came with 3 corporate owned offices that we own directly rather than being franchised. And one of those offices we franchised out in September 2022. So that the revenue from a corporate office, obviously you're getting all the fee income that arises on the sales, as opposed to say 10 or 12% MSF. So it sort of does have an impact on the revenue side, but equally it has an impact on the cost base as well. So that had a net impact on revenue of 3.6 million, and our like-for-like growth in revenue was 500,000. Management service fees, these are our key underlying revenue stream from franchisees, and still represents 54% of our contribution to gross profit. So a really big part of our ongoing revenue. And they were up 2% to 11 million. Lettings MSF was up 400,000, of which 300,000 was from the underlying network, effectively like for like. Sales MSF, it was down 200,000, and that was having added 100,000 from the Mr. and Mrs. Clark network that we acquired. So the underlying sales were down by 300,000, but as we said before, reflecting the shift in the market from 21 into 22. And on the corporate office side, our income was down 100,000. Like for like lettings was up 100,000, but the sales fees were down 300,000. And then in addition, we had the net impact of the movements on the Nicholas Humphreys offices. So as I said at the start, a lot of moving parts on the revenue side, which makes the explanation and trying to make a value comparison on the like for like quite difficult for investors. But that's why when you look at the preliminary statement and in the annual report, there's quite a detailed table to try and help investors understand where the growth has come from. On the administrative costs, they were up 1.5 million to 11.2 million. The acquisitions and disposals added a net million, and of the remaining 500,000, 400 was an increase in staff costs, and 100,000 was an increase in general overheads. Some of it actually came as a result of slightly still getting back to normal post-COVID, because if we look back to the comparative year of 2021, we were still locked down in the first part of 2021. And obviously in 2022, we've seen inflationary pressures take effect as well. And the final dividend that will be paid in May will be 5 pence, and the total dividend for the year will be 9 pence, and that's up 6% on last year. So just on this slide, we're just looking into the way the gross profit has built up since we floated in 2012. So back in 2012, Belvoir was purely the Belvoir brand, and it only did lettings. And as you can see here, that's a red line. You can see how that's built up. The green was us introducing sales. We did a bit of a trial on sales in 2013 and started to build that up. And then we acquired in 2014, our gross profit was 6.5 million. And then from 2015 onwards, we started our acquisition journey. So in 2015, we acquired Newton Fallowell, which is a big estate agency network in the East Midlands. And in 2017, we acquired Brook Financial Services. So started to build our financial services in more earnest. And as you can see through the list there, listing out our various acquisitions, that's built up the growth across lettings, sales and financial services over that period. So if we look at the gross profit, it's increased by 13.8 million from 2014, when it was 6.5 million. So that over that 8 years. Of that, if you looked at the businesses, the gross profit of the businesses at the point when we acquired them, they would have added 9.7 million, and the balance of 4.1 million is effectively organic growth over that period. So we can see here that the impact that has come from the organic growth and indeed the acquisition strategy. And the final point there, I think Dorian's already really covered by financial services. It's made quite a big contribution, and we feel that the diversification into financial services has been a big positive for the group. Just looking at the balance sheet, we can see that the intangibles have moved by £4 million as a result of the acquisition of Mr. and Mrs. Clark and the Time Group. The other probably balances just to pull out are what we call the UIC balances. As a reminder, UIC stands for Unearned Indemnity Commission. This is commission that we earn. Well, this is to do with where we sell a life insurance policy. We earn all the commission up front, but if that policy is cancelled by the end client within 4 years, there's a clawback on a straight line basis. So at any point in time, we have a potential for these policies to be cancelled, and we calculate what the UIC liability might be based on our historical experience of what we call lapses. So this at the end of 2022, it was 2.1 million. At the end of 2021, it was 1.5. And the big move there is purely because we bought the Time network, which obviously came with its own historical UIC liability and position. So as a positive in the asset side, we have UIC balances that they're 2.7 million. This is made up of 2 million, which is monies that are retained by Mortgage Advice Bureau. So we operate under the MAB umbrella for their own, if you like, I guess, protection of anything going untowards with us or with UIC. They actually withhold funds from us that they keep in a bank account under our name, if you like, but within their control. And they've effectively withheld £2 million worth of our commission as a protection against UIC. And in addition of our potential liability of 2.1 million, we had the potential to claw back 700,000 of that from advisors. And as I say, these balances have changed around in the last year purely because of the acquisition of Time. On our net cash, and I'm delighted to be able to say net cash, our net cash, net debt situation, we had cash at the end of the year of 3.2 million, and we had a bank debt of 2 million, so that left us with net cash of 1.2 million, and probably the first time we've been in net cash position since we acquired Northwood in 2016. So that was a really positive position to be in. We have repaid the remaining 2 million of the bank debt on the 1st of March, and we have put in a £1 million overdraft facility just to give us a little bit of flexibility if an acquisition came along that we wanted a little bit of help with. That's there, and our bank balance at the as on Friday was 2.9 million. On our cash flow, the business, those of you who've been following us will remember it's highly cash generative. 107% of our EBITDA in 2022 converted to cash, giving us cash from operating activities of 10.8 million. We have invested during the year £4 million in Mr. and Mrs. Clark and the Tyne Group. We sold this Nicholas Humphreys Burton corporate-owned office. We franchised it out to the branch manager, and that brought in income, brought in cash of just under 700,000. And as we can see there, we've got 2 lines: franchise loans granted of 900,000 and franchise loans repaid of just under 800,000. These are part of our assisted acquisitions program. So we continue to offer financial support to franchisees to facilitate those transactions. Just on the financing activities, as we talked about, the bank debt, 6.8 million paid during the year, and the dividends paid during 2022 totaled 3.2 million. And just in case any of you are worried that when you compare it to 2021 it looks as if we have gone down, we haven't. We've gone up in our dividend, but 2021 included a £500,000 catch up from the final 2019 dividend that was suspended in 2020. Hopefully soon the legacy of COVID will be behind us. So just the final slide for me is on our group ESG strategy. We spent a lot of time in 2021 pulling our strategy together, and we came up with these 5 pillars that we are focusing on. During the year, we've made progress against these. I'm delighted to say that in our latest survey, 85% of our staff said that they were proud to work for Belvoir. So clearly we're going to have to work hard on the remaining 15%. We rolled out some additional staff benefits, which included a Medicash medical scheme, birthday leave, which went down extremely well, and a cycle to work scheme. We launched a new training academy for franchise and staff, which hopefully will nurture talent across the group. And we're also engaging with our franchisees on their green agenda, because we feel it's quite important to flow down some of the initiatives that we're embarking on to our franchisees so that they can take some similar steps in their business. And a big thing for this year, we've measured our carbon footprint, so we now have that as a benchmark as we move forward. And on that note, we aim to become carbon neutral in 2024, and we're looking to achieve net zero thereafter. So on that note, it's back to Dorian.
Louise, that was great, thank you. And before, just when you thought you'd done your bit, do you mind if I ask some of these questions? No, there are actually some really good questions in here. So we've got one of the pre-submitted questions, date and time. So date, time and place of the AGM.
Yeah, so the AGM is on the Thursday, the 18th of May at 10 o'clock in the morning, and it's at our central office in Grantham.
I'll do the other 3 pre-submitted questions towards the end. Let's have a look. So I guess this one's for both of us. So Ian D, so anybody who's listening, these are the questions, warts and all. So Ian asked, you referred to FinCap's target price, I guess it's for me, of 375. I appreciate that different brokers make their calculations on different bases and timescales, but this relates to your, in your opinion, it related to your share price today of 172, 40% down this year, is unhelpful and frankly does not help your company's reputation form the shareholders' view. Would I like to comment? I think first off, I mean, FinCap is FinCap and Belvoir Group is Belvoir Group. We don't set the target price, and clearly FinCap arrives at their analyst arrives at their sort of decision and based on their own research. It's not something we can sort of heavily influence. I think if you want my personal view, I think that we should be valued higher than we are at the moment. It is disappointing about the share price over the last sort of few months, but on the other side of that, we've had a lot of positivity today. We've had a lot of press coverage. I've seen some of the comments sort of online. I guess that some people are using it, as an opportunity to buy some shares. But we're working extremely hard to grow the business and grow the business we have. This is our sort of 26th year now of unbroken profit growth after tax. Profit after tax has risen by 3 times over the last 5 years, and we will continue to grow, but it just feels at this current level, I think, as you rightly say, that that's not being recognised. But I guess it's a marathon, not a sprint, really. And as far as we're concerned, so hopefully that answers sort of one question. Another question that from John, again, a great question, and perhaps we can learn from this one, Louise, if we need to just put something in the presentation. John says, could you explain the relationship, if any, with the Mortgage Advice Bureau? You state that Time operates under Mortgage Advice Bureau, but the latter is a separate listed entity. It sounds contradictory, but it is my understanding that's lacking. So just to clarify, Mortgage Advice Bureau, if a mortgage advisor wants to trade as Mortgage Advice Bureau, if they're a small single operator, they can't. So if they approach Mortgage Advice Bureau, MAB aren't interested in recruiting single advisors. What MAB will say, they'll direct that person to a group like us and say, look, Belvoir also has a division that trades as Mortgage Advice Bureau. Please approach them and you can join under their umbrella. So we are one of the ARs underneath Mortgage Advice Bureau. It's not a franchise arrangement, but it's similar to a franchise arrangement. It's a license arrangement, and it isn't just us. MAB have got a number of sort of large networks who have their own advisors. So just to be clear, our mortgage advisors are our advisors, and we choose to contract with Mortgage Advice Bureau. It's a partnership made in heaven. We really like the brand, and in return for a part of the commission that is paid by lenders, in return, MAB provide compliance, website access to lenders, training, all sorts of things as part of their sort of umbrella arrangement, and it just works really, really well for both parties. So hopefully that sort of explains. If not, John, let me know, and we could always sort of speak separately. So. Another one definitely for you, Louise. So from the figures, this is from Ian again. From the figures I'm looking at, it would appear that some are forecasting lower levels of revenue, profit after tax, and EPS for next year. Is this how we see it, and what steps are we taking to change this projected pattern?
I presume that Ian's talking about projecting lower levels for us, as opposed to other businesses projecting themselves. I'm not sure. Yes, and I think it's whilst 2022 wasn't as strong for the sales market as 2021, it was still the second best sales market since 2007, apart from 2021, if that makes sense. So it's still a very good year for the sector. So we do expect to see sales transactions step back a bit from that most commentators in the property sector do. Equally, some of the financial services business does derive itself from sale of new houses, and we are fortunate because we've got a strong client back that we can actually mitigate some of that from selling remortgages, which is quite important to us. So there was definitely a big drop off in mortgage applications in the last quarter of 2022 because of the turmoil as a result of the mini budget, and that has a lasting impact, because the business that we were writing in the back end of 22 is what drives what we call banked business that actually comes into our revenue in 2023. So which is why we came out in our trading update at the end of January and actually pared back our numbers for this year. So as always, we've been as transparent as we can be with our numbers. So yeah, we have expected that 2023 won't be as strong as 2022. But having said that, what our forecasts never build in anything that we might do on the acquisition side, and as Dorian has, I think, has referred to, you know, we've got acquisitions that we do at a franchisee level, where our franchisees do assisted acquisitions that build up their lettings portfolio, and then there's acquisitions of more substance that we do at a corporate level, and none of the forecasts build in what we might do on that front. We're very cash generative, and we don't intend to just sit on that cash. We intend to make it work for us. So whilst in the forecasts at the moment do show a step back, I think I'd say watch that space, because it's not a, you know, we don't like going backwards. We will be taking steps, as Ian says, to change that projected pattern.
Thanks, Louise. And somebody else, it wasn't a question, somebody else said that they liked your chart showing segmental growth. So I thought I'd do that one. So that'll disappear off the list. Another couple of questions. So if you want to do the first one, I'll do the second one. What performance metrics are the LTIPs based on? If you do that one, someone else has asked who are the biggest shareholders and what percentage of shares are held by management. So if I do that one, if you do the first one, how's that?
Okay, that sounds fair enough. So there were some share options that were issued to the executive directors and senior management team in 2021, and they were based on growth in EPS and growth in EBIT. I think it was EBITDA and EPS, but certainly EPS over a period of 3 years, which we and that was put in the RNS at the time what the growth was. Off the top of my head, and I know I should know this a bit better, but it was effectively a growth of 15% a year, so a fairly strident hurdle. And the ones that were issued last year were linked to us achieving what was in our broker's forecast at the time over a period of 3 years, as a benchmark, and then increasing for being effectively over that. So it's entirely linked to, it's not linked to the share price, but it is linked to earnings per share.
That's great. Thanks,
and
Louise.
I think actually, sorry, just one final point on that. If you look back at the RNSs, it is set out in detail in the RNSs. And I think one lot was issued, I think, around the 1st or 2nd of July 2021, and the others were issued in August 2022.
That's great. So the other question was, a question that we get sometimes. So somebody asked, who are the biggest sort of 5 shareholders? I can tell you who the biggest 4 are, the biggest institutions. You've got Gresham with 13.58%, Canaccord next at 7.2%, Unicorn after that 5.43%, Lion Trust after that at 3.76%. And then you've got a chunk of management. So the second part of that question was what percentage of the shareholder base is in directors' hands. It's about 5%, give or take. So that's just the other answer. So what I'll do is I'll continue with the presentation, which might take out some of the other questions. If not, I'll revisit all of them at the end. So what I plan to do now for a few minutes is to talk about the operation in slightly more detail, which might help answer some of the questions. Then I'll talk about the markets, each market that we operate in, that's sales, lettings, and mortgages, and then we'll sort of come back to the questions. So some of the operational highlights. Number of franchise territories, that's property. You can see the direction of travel since 2018, so we're now at 338. I've covered the sort of main points in that we acquired Mr. and Mrs. Clark. I mentioned that house sales were down last year. I think one of the reasons that they were down last year was because the previous year was so good, so please bear that in mind when you're looking at sort of house sales. The average MSF, the average management service fee per franchise is up 2% to 34,000, which so MSF essentially is 34,000 per franchised office. The average revenue of a franchisee, that's why I stumbled for a second, is around 316,000 per year. So most of our franchisees are in retail units. They've got 4 or 5 staff, and the average revenue is 316,000. Interestingly, we've got 4 single offices exceeding $1 million of revenue, with the largest at 1.3 million. We've got 16 franchisees exceeding 1 million of revenue from a collection of small offices. So the largest has around 5 offices. And the largest franchisee now, who actually does have 5 offices, is generating 2.1 million of revenue each year. We do have a franchisee who declared 750,000 of net profit last year, which was a, when I look at those numbers, I'm just so pleased for the franchisee. It's just great. We've got 59 franchisees who have got 2 or more offices, 17 with 3 or more. We've got 62% of our traditional lettings franchises, i.e. Belvoir and Northwood, are now actively selling houses, which might sound strange, but we've come from a background of lettings and we've entered the estate agency sector. Therefore, we still have some franchisees who just don't want to be involved in estate agency, and that's down to them. 32% of our offices now offer mortgage advice through a group advisor. I think one of our focuses for this year is there are some changes coming to the letting sector later this year. You've got the Renters Reform Bill. You've got a new ombudsman, which I've been calling for years. So historically, if you rent through a letting agent and something goes wrong, you can go to an ombudsman completely free. And if the ombudsman feels inclined to do so, they can make an award against the letting agent of up to £25,000. If you rent privately through a landlord who doesn't use an agent, and about 50% of landlords don't use an agent for anything, and about 50% do. But if you go to a private landlord, no agent, if something goes wrong, your only redress, or your main course of redress, is the courts. There isn't an ombudsman available to you, but there will be, and that could be quite beneficial for agents going forward. So I'll move on to the next operational slide. So on financial services, I mentioned we've got 284 advisors. Back in 2018, we had 123. So you can see the direction of travel. We are still very keen to continue to grow the FS business this year. Net financial services commission, 4.7 million, which is up 22%. We wrote 18,329 mortgages last year. And again, if you look at the bar chart, you may be able to see that back in 2018, it was significantly less. I think we've got 2,500 on there, if I can say that properly. It is yeah. There you go. And lending from group mortgages, this is gross lending, it's 3.2 billion, which is up 14%. So the FS business, we know that the FS business faced some headwinds in Q4 last year. The mini budget was particularly disruptive for mortgage businesses in that, firstly, interest rates rose at a quicker rate than I think people expected, which to me did nothing more than cause almost a paralysis, really, amongst the millions of people who may have fixed their mortgage in Q4. It's not millions in Q4. It's just under 2 million people a year sort of come to the end of their fixed rate deals. But in Q4, it caused paralysis. Those people still, and I'm one of these people. These people still want to change their mortgage deal and fix. And again, I'm one of them. I had a quote back in October from my lender when I was looking to fix, and the rate I was quoted was over 6%. I had a quote I didn't fix at the time. I held back. I had a quote 2 weeks ago, and I was quoted by NatWest, 60% loan to value, 3.99. So the mortgage market is very competitive. In Q4, a lot of the mortgage deals just disappeared. So if normally there are, let's say, 18,000 mortgage deals available, that dropped to about 7,000 in Q4. They're now back up to 17,000. So the mortgage market is operating as it should. And in my mind, we're just returning back to historically normal level of interest rates. But I fully accept that for the last 15 years, but people just haven't been used to paying that level. But the adjustment is certainly happening, and people are still buying properties and still moving home and still remortgaging. So if I move on to the markets, I think that's probably I think people are probably quite keen to hear what our view is on the markets. So the lettings market, first of all, I've had 1 or 2 questions about the lettings market. Let me just find one of those. Right, so one question is, are your managed properties mainly buy-to-let properties? Is this still attractive for property owners? That was one question to do with lettings. I've had another question about sort of student lettings, which I'll try and cover as well. Let's have a look. Brilliant. So what was that was the one I was looking for. So this is a very common question that we have. This was pre-submitted by Jake. Thank you, Jake. What impact are and will government's anti-landlord policies having on Belvoir? In particular, do you foresee fewer properties for private rental? Are the big operations like Legal and General marketing their properties through Belvoir? So that's a question that we're getting quite a lot. I personally think there's been a lot of misreporting about the number of properties in the private rented sector. I saw a newspaper. I saw a piece in a newspaper within the last sort of 10 days said that 500,000 units had been lost from the private rented sector. I'm not sure where they got that stat from, but it certainly wasn't ONS. There is only one measure, bar the census, there is only one measure of the size of the private rented sector, or one way of measuring it, and it's via ONS. It's the English Housing Survey. It's quite an interesting document. It's produced each year if you want to have a look at it. It's financial year, so please bear that in mind. And ONS are reporting that in the financial year 2021 to 2022, the number of properties privately rented in England increased by 170,000. Now, I accept that doesn't include the last sort of 8 months of last year, but I suspect the sector was stable in those 8 months. So we have seen, of course, some landlords will exit the sector, but at the same time, other landlords enter the sector. Commonly, a landlord is a small landlord. The average number of properties that a landlord owns in the UK is 1.8 properties. We're not seeing any particular change to that, but we are, build to rent is something that is going to be very useful for our sector in the main. We need more properties, but it's still relatively small. As I understand it, there are around 200,000 properties either built under build to rent or in the pipeline for build to rent. But the fact of the matter is there just aren't enough rental properties to satisfy the demand that's out there. And herein lies the challenge with rents going up, well, the real reason why rents are going up. Rightmove are reporting that 50% that tenant demand is 50% higher now than pre-pandemic, and yet the number of properties on offer are much lower. If you've had any experience of renting in the last 12 months, you'll know that if you want to rent a property, you are probably competing against 10 to 15 other people. That's not a great position for agents to be in, because we want to make everybody happy, and we want to service our tenants properly, and as well as our landlords. But we just not seeing enough properties sort of come to market. Whether any political party will have the will to incentivise landlords to come into the market is yet to be seen. On the rental side, so in terms of rental inflation, what this graph shows is the thick line is rental growth on all tenancies tracked by ONS, and that's currently running on the graph. It's running at 4%. As of the end of February, it's now 4.7%. The red line is rental growth on new lets, because this can be quite confusing. I have a lot of people say to me, well, rents are going up by 10%. They are, but only on new tenancies. Not across existing tenancies. Across existing tenancies, rental inflation is just under 5%, so much higher than it was, but it's not the 10% that you see in the sort of headlines. Most regions in the UK are seeing rental inflation on new tenancies of around 10%. That's in every region. The grey line shows earnings growth, so you can see that earnings growth or rental growth on lets generally follows wage growth until the last 2 years. Then the lines start doing something different. So that's why we just wanted to put that on the screen. What I suspect will happen is that affordability will temper rental inflation, I suspect, in the second half of the year. However, unless we can find a way to increase rental supply, then ultimately, or dampen demand, then ultimately this supply demand issue is going to remain. The good news is, so far this year, revenue-wise, so last year revenue from lettings was up 5% in our business, and franchisees are reporting that lettings revenue is up 6% in the first 2 months of this year. Okay, so the residential sales market. So what we're showing on the screen here is the blue blocks represent housing transactions going back to 2006, and the red line shows house price inflation. So you can see the pattern of the blue bars. The number of properties being sold in the UK before the credit crunch, 1.6, 1.7 million a year. Dropped off in 2008, and property prices also fell in 2008 by around 15%. Then the number of properties being sold increases to what I used to call at the normal level, which was sort of 1.2 million transactions per year. That fell off in 2020, massively increased in 2021, and then normalised in 2022. So it just shows you the sort of pattern. What we think will happen this year is that we'll see around 1 million transactions. So we think there'll be less transactions, fewer transactions than last year. We don't think it's going to be less than 1 million. We don't see why it would be above 1.2 million. So the range is 1 million to 1.2 million. Perhaps we've been too cautious on our outlook. That's just yet to be seen. But ultimately, when we put our outlook together at the start of the year, it was very difficult to forecast what was going to happen with property prices and mortgages and transaction volumes. Just to give you an idea of where the market is right now, so when someone makes an offer on a property and it's agreed, it's called sold subject to contract, which I'm sure you're familiar with. There have been, up until the end of week 11 this year, so right up to date, in the UK, there were 230,000 properties sold subject to contract. That's about the same number for the same period in 2017 and 2018. Both years, as you can see on the screen, saw 1.2 million transactions. So what I'm not saying is it's going to be 1.2 million, but it'll be somewhere between 1 million and 1.2 million. That's our best estimate. Property prices are cooling. So Rightmove are reporting that annual house price inflation is now running at sort of 3% on new properties coming to market. ONS is reporting about 6.5% annual growth at the moment, up until the end of ONS runs to the end of January, if memory serves. So property prices are cooling. That doesn't have a particular impact on our model. Up until when we reported our interims last year, property prices had risen by 10%. So actually, if they fall back by 5 to 10% over the next 12 months, I appreciate if you bought a property and you've got to sell it immediately, that's a problem. But for most homeowners, that's not a problem. But just an interesting fact that's not in the presentation, that over the last 85 years, 69 years have seen positive house price growth and 16 years have seen negative. So, some are up, some are down. The vast majority see positive growth. And then onto the mortgage market, onto the sort of the next slide. Thanks, Louise.
Hang on, I've lost my cursor.
No problem. And what we're trying to show on this slide is that that you've got the red line, which shows remortgages, you've got the blue blocks, which show house purchases, and then you've got house transactions at the top, which is the same as the previous slide. And what we're showing here is that in the back end of the year, bear in mind that 2023 and 2024 are projections in here, that you're just seeing more remortgages, clearly as people come off their fixed rates. Historically, they've had no incentive to jump on a new fixed rate because rates have been so low. We're seeing a lot more activity on the remortgage side, unsurprisingly. Last year, also, this might help answer somebody else's question. The market saw record buy-to-let lending last year of 56 billion, and anecdotally, we are receiving more inquiries from landlords with no gearing, so people who have got cash, they're looking to enter the sector, and clearly the returns for them, aside from a little bit of uncertainty over house prices, for them to enter at the moment, may give them the returns that they're looking for. Okay, so just a very quick sort of recap, and then we'll tackle some more questions. So why invest in Belvoir? Well, we have 7 brands. You can join us as a home run personal agent via Mr. and Mrs. Clark. You can buy resale, and we sell or resell around 25 of our franchises each year. You can buy an existing business with healthy levels of profit, and then we will train you to operate that business. Or you can join as an established mortgage advisor, or you can join as a trainee mortgage advisor. So lots of ways that you can enter the business. We've had 26 years of unbroken profit growth, and profit after tax is up threefold in the last 5 years. We have got a strong leadership team. So behind us too, we've got another 13 operational directors who are fabulous. Some of them have been with us for 15 or 16 years, and they run each part of the business. I've got a very experienced team. We traded successfully through the credit crunch. In fact, we floated not long after. We traded successfully through the COVID period, and we had a lot of very happy investors with the way we managed the company during that period. And we're both very confident going forward. We've made 10 corporate acquisitions since 2015. And again, I've had one or two questions about what's our appetite for acquisitions going forward. Well, we are net cash. We are generating cash at a fairly quick rate. I will be very surprised if we didn't make any corporate acquisitions this year. We tend to sort of acquire one or two at corporate level every year. We haven't completed on any yet, but there are sort of businesses that we are very keen to acquire if everything stacks up. We were quite cautious in Q4 last year. We could have made more corporate acquisitions in Q4, but we decided not to. We wanted to hold back to understand the direction of the market. So that the point being that we're very, very acquisitive, and it's very likely that we will do more corporate acquisitions this year. The franchisee pipeline for acquisitions, as I mentioned at the beginning, is also very healthy. I think that's it, Louise. I think we'll leave that slide up on the screen, and I'll tackle some more of these questions. So Jake, pre-submitted question: what is one of the biggest problems Belvoir's franchisees are facing this year, and what are our thoughts on this problem? I think just the changing framework of regulation, I think is if you ask a franchisee, that's not a problem per se, because it could represent a really good opportunity for us to win more clients. But I think the franchisees, when they have to change internal systems, the abolishment of Section 21 notices sounds like a problem, but ultimately, if that's a mechanism whereby a landlord can take a property back, it's going to be replaced with another mechanism whereby a landlord can take a property back. But the changing process can be quite challenging sometimes. But our thoughts on that is that we provide all of the support that a franchisee needs to navigate their way through any of those changes. Somebody's asking whether we can sort of do more to, or what can be done to grow in the northeast, given the population around Tyne and Tees. It's a good question. We do have franchise resales in that area, and normally we recruit people and not places, if that makes sense. So if somebody comes to us and says, "Look, I want to buy a business," normally they want to operate it within about an hour of where they live. So I think it's not just Tyne and Tees that we don't have coverage. We cover, I want to say, about a third of the country geographically, maybe a touch more than that now. To cover the whole of the country, we could do with 1,000 to 1,500 sort of property franchisees, which might help answer another question that somebody else asked. Bob has asked what our most ambitious target is for the business and shareholders over the next 3 years, and what, if anything, could derail us. Well, we are ambitious, Bob. We work very hard in the business. We have delivered what I think is pretty good growth. I accept the fact that we're not going to strike gold tomorrow, and the business, it's not suddenly going to, be stratospheric growth. But actually, we've delivered good growth to shareholders. We've been very consistent with our dividend. Dividend is forecast to grow over the next 3 years, and all of these numbers are in FinCap's note. And we've got a clear growth strategy within each part of the business. So to summarise, estate agency, we are continuing to grow that by means of we've got Mr and Mrs Clark, and we're also growing our footprint on estate agency. Newton Fallowell is our biggest estate agency brand, which operates in the middle of the country. We will expand that. On the letting side of the business, we're helping our franchisees to acquire. We do have reasonable growth on the letting side, and on the mortgage side, it'll be organic and it'll be acquisition growth. So, you know, we are being offered businesses on the FS side at better multiples than last year, and we will be opportunistic and hopefully secure some of these businesses. Somebody asked about student lettings. You know, could we? Is there scope to keep growing the student lettings portfolio? Yes, there is. You know, it's something. There was a little bit of uncertainty over student lettings because with some of the changes to tenancy agreements, it was making sort of student letting agents and student landlords a little bit nervous. They're no longer nervous because the government has changed their that particular part of the legislation. So you know, we're very positive about students. Let's have a look. Yeah, somebody's saying that, you know, do we anticipate that the difficult trading conditions in our field will continue to be more difficult in the next year at least? Do we think this will increase opportunities for M&A? Yeah, definitely. Ian, I mean, you know, I'm not particularly. I don't particularly agree that the letting sector is particularly challenging at the minute. I think it's just full of opportunities for us. I think estate agency is normalising, but it does have some headwinds. You know, clearly, if transaction numbers are going to be slightly less, and I think on the mortgage side, as you exactly as you say, I think the opportunity for M&A activity is squarely within our sort of tried and tested model. So somebody else says congratulations for being debt free. Do we have enough cash or overdraft? Well, and do we have enough cash or overdraft facilities to make the sort of acquisitions that we should be targeting to meet growth?
Yeah. So shall I just pick up on that one?
Sure.
Yeah, we had the opportunity to put in place you know, quite a substantial revolving credit facility. You know, sort of 10 million or 15, whatever, you know, they weren't wherever we wanted, but a large amount. But all these things come with quite a price tag to them. You know, there's quite substantial fees for putting that in place. If you don't use it, you still have non-utilization fees, and we have those strong relationship with the bank. So we put in a relatively small overdraft facility, £1 million, which at the moment we don't have any need to, you know, for sight of using it. But it gives us a little bit of cash there to oil the wheels if we wanted to do a small acquisition. But I do know that by having that facility there, it will be quite easy, given the relationship we have in the bank, to extend that up if we needed it. And we're very cash generative, so the danger is we only need cash for a short term, and locking into a term loan, which is quite expensive, isn't the right answer. So investors may feel there's not the funds there to sort of go out and make a £10 million acquisition or £15 million acquisition, but in the time it would take to get that sort of deal together, I think the bank would have put something in place for us. You're new to doing.
Brilliant. Thanks, Louise. So I've got another few questions. Are there any regulatory risks regarding offering a combination of financial services and estate agency services? I mean, to be clear, we don't have any of our estate agency staff involved in writing mortgages. So all of the mortgages that are being written by mortgage advisors who generally are not sitting inside the premises. Matthew, they can, if they want to, they can spend a day, you know, in a branch and see clients if they wish. But as far as the estate agency business is concerned, you know, it's just a straightforward sort of referral. So, you know, there are regulatory risks with everything, you know, relating to mortgages. But, you know, we think we've got, you know, the right controls in place to deal with that. John has asked what makes the financial services sustainable long term versus comparison sites. That's a really interesting question, because I mean, what we are seeing on the high street is that we're seeing, bear in mind that we're one of the one of the few companies now who maintains, you know, pretty healthy footprint of offices all over the UK. Franchisees generally pay between £12,000 a year and £20,000 a year for a retail unit. But what we have got is, where you've got the banks disappearing from the high street, we still have physical offices where a mortgage advisor can sit if they wish to see a client face to face. And we still have a lot of clients who really value the face to face advice. And, you know, if I use me as an example, John, when, you know, I jumped onto the NatWest app a couple of weeks ago, I wanted to check some of the mortgage deals. I clicked all the buttons. I saw some of the deals that were available. And then I soon started scratching my head because I've got 3 different mortgage. I had a further advanced, and I've got different parts of the mortgage. I've got 3 different products, 2 different rates. I've got salary, I've got dividend, and before you know it, I'm not sure that many people fit the standard box. I think a lot of people actually do want advice, especially when they're buying as first-time buyers, especially when they're buying in a partnership. Personally, I've also I've had a mortgage online. I remember many years ago I did it. I did a buy-to-let mortgage 100% online without any sort of broker advice many years ago, and it was quite a torturous process. So we feel we offer good service and good advice to clients.
Just a question there from John about putting the return on capital employed to be added as a measure of capital deployed. I think that's a good point, John, and maybe that's something we look at doing in the future. In effect, it was something we were trying to not in terms of a defined metric, but we were trying to convey on the financial services the extent to which that has given us quite significant returns since we've made investments in it. But I think that's a good point, and something we should perhaps take on board.
That's great. I've got somebody else has asked if we are at Mellow in Chiswick in May.
Certainly are.
So, we are. We've got a quite good following at Mellow. We enjoy going. We've tried successfully or unsuccessfully to engage as best as we can with all investors and retail investors over the last 3 or 4 years. I think Mellow is a great place to do that face to face. So I imagine we'll be presenting there, and we'll certainly have a stall there. Let's have a look. Ian said, good answer to the query on the finances for M&A. Right, another interesting one. John has asked, how do we make Mr. and Mrs. Clark a resellable asset with intangible value over a franchised job that can have less value over time if people leave and do not resell to a new franchisee? Well, that's quite interesting, is that I think what you're sort of saying is that the personal agent models don't have the same resale value as a retail unit. And you're right, the turnover is much lower in a personal agent model, much lower. Bear in mind that our average turnover per office is about £315,000 a year. If you look at the home run estate agency models that are operating in the market, I suspect most of them are averaging 30 to 40k per unit. Significant difference. Our franchisees' businesses are resellable in that they come with staff. They've got staff, systems, and we've proven this by selling a number of them each year. The highest value franchise resale that's gone through was over 1.5 million, so they're definitely resellable. What we've done with Mr. and Mrs. Clark is in their new franchise agreements, we've introduced the concept of those businesses being able to resell. We're also going to introduce lettings to Mr. and Mrs. Clark, which then gives an element of recurring revenue. So I think that the Mr. and Mrs. Clark franchises can be resellable in the future, if that answers the question, John. Let's have a look. Somebody's asked, what do you want your market cap to be in 2026? It's a good question, Bob. I think what do I want it to be, and what will it be? We had a sort of board strategy meeting a few months ago, and first and foremost, our immediate goal is to get back to 100 million market cap, and I think we've got the right strategy in place to do that. We've been there pretty much, and as I said at the beginning of the presentation, I think the share price really has been marked down quite. I just think we're undervalued at the minute. I won't hide my sort of views on that. And then beyond that, we appointed a new chairman last year, John Stefano. He's the ex-CEO of Telford Homes. He's 48 years old. He's a build-to-rent guy. He's also a property developer, a house builder, and the reason that we appointed John was that he's got direct experience of running an AIM business that has grown beyond 100 million market cap and beyond 200 million market cap. So we're in this for for the long term, and John's actually been there, done it, and we wanted his skills on the board as a non-exec. He was then sort of made our chairman in October next year. So that's our sort of two goals that we've got at present. Somebody, John T, I haven't answered one of John T's before. So John T has said the industry has low barriers to entry and is very competitive. At present, the franchise model is what's giving us an edge over other property management businesses. If competitors were able to replicate this model, what other advantages would Belvoir have over them? I think we've had competition, John T, for as long as I've been with the business. It just varies and it's different, year to year. I remember when Purple Bricks launched 5 years ago, in presentations, people said, "Well, Dorian, surely this is the end of you, really. The end of your business." And clearly it wasn't. We are very good at property lettings. To me, property lettings and property management is a complex process, and it's very different to a estate agency. And we haven't seen any sort of competitive threats on that side, simply because I don't think we charge a great deal on the property management side for what we deliver to a client. It's very much boots on the ground. We visit properties, we check, if gutterings need cleaning out, we organise that. We go and oversee boilers being changed and kitchens being remodeled, and doing all of that requires people on the ground. We've got about 2,500 people in the business. Some of those are our staff, about 150, 55, and the rest are sort of staff or franchisees, all franchisees, which means we've got a lot of boots on the ground to deliver proper property management. There isn't a tech solution that can replace an on-the-ground property manager, or certainly not the moment. So we think our good service helps set us apart, but we also think our depth of understanding in property management really does set us apart, and can't easily be replaced by technology.
It's interesting because John T was saying in his question about the franchise model giving us the edge, and what if other businesses were able to replicate that franchise model. And I think the truth is Belvoir, through the likes of Dorian and Mike Goddard previously, have massive experience of franchising. And whenever companies try and do franchising from scratch, they often fall into the same traps and make the same mistakes. It's not easy. And I guess undoubtedly after whatever it is, 27 years, we know what we're doing. And I think it's replicating the model is one thing, but getting the model right is another thing altogether.
I think I'll try and just tackle one more, because I guess we kind of we're just over time now. So again, a question that we get quite often: are your managed properties mainly buy-to-let properties? Is this still attractive market for property owners? Interestingly, buy-to-let's had the kitchen sink thrown at it really since 2016. It started with the phasing out of mortgage interest tax relief, and then we've seen a raft of changes over time. I think it was pretty clear that government wanted to take the fizz out of buy-to-let, but my view was that they weren't looking to shrink the size of the buy-to-let sector, because it provides housing for 13 million people. And what's the alternative? Social housing isn't being built. There are 1.5 million people waiting for social housing units, and the PRS, the private rented sector, providing housing for a lot of those people, as well as people who want sort of privately rented properties. So what I'm kind of coming to is that throughout the whole of that period, even though landlords, and I'm a landlord, I've got a portfolio of properties, so I sort of share the pain on this one. Although landlords have felt that they've had a lot thrown at them over the last 5 years, when anything changes in our sector, normally landlords sort of say, "Oh my God, I'm going to sell the property. I can't possibly continue." And they don't. The stats bear this out, that the sector has grown over the last 18 months. And I think landlords, unless they're very, very highly geared, I think landlords have done reasonably well over the last 5 years with capital gain. Obviously, it depends on their investment strategy. And we are receiving more inquiries than we've seen for quite a while, Stephen, from landlords who don't have any gearing. So I suspect that over the next 12 months to 2 years, we'll see more landlords joining the sector with very low gearing. I completely accept that if you're a landlord with very high gearing, that the phasing out of mortgage interest tax relief, for example, has probably put some pressure on you. The type of landlord with 50 properties and exceptionally high gearing isn't a typical client of ours. So generally we deal with landlords with 2-3 properties. They've got a full-time job, school teacher, policeman, whatever, and they just don't want the hassle of somebody calling them at 3 o'clock in the morning to say that their boiler's broken. It's that sort of landlord, and we offer a turnkey solution for that. So that's probably a good place to close. Just thank you for all of them. We've had some really nice comments as well from people just saying well done for performance in a tough market. Somebody else said, great performance since IPO, and somebody else said, great presentation and Q&A. Thank you very much. So that's a good place to end the presentation. So thank you for listening.
Thank you for everyone for coming along.
Dorian, Louise, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Belvoir Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.